Things you and I've talked about is the debt refinancing, especially in the financial markets.
Mhm.
Where do we stand as it relates to that phenomenon? The capital moving into financial markets, but also needing to kind of service debt or roll over debt.
Yeah, I think this is a big question. This is a big question that everyone has to face, not just in the US but worldwide. And that is that capital markets today have transformed from being what the textbooks tell us they are, which is mechanisms for raising new money for capex, into debt refinancing mechanisms. So what you're looking at is something like 4 out of every 5 primary transactions now in a financial market worldwide is a debt rollover in some way. Okay. It's all about rolling over the debt that we've taken on historically. It's not only about taking on new debt. This is just talking about the old debt. And so this is the process that financial markets are already doing. They're rolling over, refinancing debt. And the linkage between liquidity and debt is really a key one. And liquidity is necessary because it defines the balance sheet capacity that is available to roll over the debt. If the liquidity is not there, you can't roll the debt over and you get a financial crisis. Now, the paradox that we sit in is one that liquidity also needs debt because most liquidity creation now is collateralized.
Oh.
So something like 75 to 80% of all lending worldwide, that's a World Bank figure, is that lending is collateralized lending. That may be collateralized on a real estate purchase, or it may be collateralized against the US Treasury bond or note in the financial sector, but it's collateralized lending. So the value of collateral is important. So if you get disruptions in the debt markets, the liquidity can spiral out of control downwards.
Are we That's an interesting dynamic too. Are we getting to the point where it's almost too much debt, or do we have still more
Oh,
room?
unquestionably.
Okay.
Unquestionably, there's way too much debt in the system, and the system is struggling under that debt. Now, the thing to recall is that if you look back at history, and history is always a great guide for these things, every time that any economy is taking on more debt, the only route out is monetization, printing money. Now, the reason for that is that debt is integral to the credit system, and you can't default massive amounts of debt, particularly government debt. So what you've got to do is to effectively dilute it by printing money, creating inflation. And that's what happens in every single example historically. Now, the problem we've got right now in the world economy is it's not just one economy that has too much debt, the world overall has.
Everybody.
Yeah, everybody has because of aging demographics.
Mm.
So the welfare commitments that are being undertaken are, are significant. And what's more, you've also got legacy debt out there in places like China. So China's had this real estate boom, a lot of it debt financed, and they're struggling under the weight of debt. So China has to monetize, and that's what it's been
Are they
doing.
they're already
Yeah,
monetizing. Yeah.
that's why the gold price is going up. This is not just about what's happening in the
Wait
West.
a sec. Can you explain what's going on with gold in
Yeah.
China then? And yeah, this and tie it back to this monetization then.
Well, China is basically in a very similar situation to what Japan was in, maybe, let's say, 15 years ago or so. And if you recall what happened in Japan after the Japanese bubble, there was basically a lot of legacy debt. Now, the Japanese took a long time to sort of realize what was going on, let's say, or to address the problem. But Abenomics, which started about, 10 years or so ago, addressed the problem by restructuring the economy and then essentially printing money by getting the Bank of Japan to buy Japanese government bonds. So they hoovered up all the bulk of the stock of existing Japanese government debt, put it onto its balance sheet, but that meant the balance sheet expanded. And as the balance sheet of the Bank of Japan expanded, they effectively printed money, which is the other side of that balance sheet. And so there was a tremendous monetary expansion in Japan. And what has happened to the yen? It's collapsed. Well, that's not any surprise. If you print lots of money, the value of money is going to go down. And so the Japanese have devalued the yen significantly, and the yen is still a very weak currency today. Okay. Now, move on 15 years and say, well, okay, haven't we got the same in China? We have, exactly. Because China went through, after the GFC, a huge real
That's
estate
right.
boom.
Yeah.
They've got legacy debt because of that. Can they default that debt? No. They've got to effectively get out of that printing money. Now, the advantage that China has got in this whole equation is that China has capital controls. So if it prints money, it stays within the system. It doesn't effectively move out. unless it does, but that may be another question. But ultimately, China is got this capital control. So they're printing money. So what assets do people buy in China traditionally if they want to protect against paper money devaluation? Gold.
Gold.
And there's tremendous buying in gold. What is moving the gold price now is the Shanghai exchange, not COMEX or the London market.